Thank you very much for that introduction. My name is Darcy Allen. I'm going to be speaking to you today about blockchain and the future of trade. Who am I? Well, I'm from a team at RMIT, the RMIT Blockchain Innovation Hub. We were set up in 2017. We spotted an opportunity at that time. We looked around and we saw there's lots of computer scientists, there's lots of cryptographers working on blockchain, but there's no team thinking about what does this mean for the shape of the economy? What does this mean in terms of regulation and so on? So we set up a team. We're economists, we're lawyers, we're political scientists, and we're curious about what this means for the economy. So what I'm going to talk about today is I'm going to introduce a little bit about what is blockchain, very briefly, non-technical, not into the gory detail. And what you should take away from that is that blockchain is a distributed ledger, and it's a distributed ledger powered by economic incentives. That doesn't sound particularly exciting. We normally think of ledgers as this really boring thing that accountants do, and that's true most of the time. But if you dig a little bit deeper and look into an economy and its structure, we make the argument that an economy is largely made up of ledgers. All those ledgers are largely held by centralised parties like firms and governments and so on. And blockchain is exciting because it is really the first type of decentralised ledger that we've been able to develop. What does this mean for supply chains? Well, I want to argue that blockchain is really a new economic infrastructure for supply chains. We can easily get caught up thinking about the physical parts of supply chains like ships and ports and so on. But we're thinking about this in terms of information costs of trade. It's economic infrastructure that's being built at the moment. And what does this mean for the future of supply chains? Well, there's a few things I want to go through. These are obviously a bit speculative. What this will probably lead to is more differentiated pricing of goods than we were previously able to do. And that means better market coordination. We're going to see fundamental shifts in the way that power is distributed along a supply chain of who has the economic bargaining power. And we're going to see a movement away from lots of different hierarchies or firms along a supply chain towards a more platform-based supply chain. So I want to start off with what is a blockchain. As I've mentioned, a blockchain is a decentralised ledger. We're used to dealing with ledgers of information like the one on the left that you see up there, centralised ledgers. So if you want to change your property title, we go to the government and we say, can you please transfer that property title to someone else? They update their ledger. They charge you thousands of dollars to do it. If you go to a bank and you want to transfer money, they update and maintain the ledger of account records. You can go on and on and on about all the ledgers that we have in our economy. Blockchain is exciting because it is a decentralised ledger that we see on the right there. Now, a decentralised ledger isn't held by any one single third party. It's held by a network of different computers. That sounds fantastic in theory, but it's a really, really hard engineering problem to create a ledger that is maintained by a network that no one controls. You need to find out who can update the ledger, who decides what's a valid transaction. How do you know that the ledger you are looking at is the correct ledger at that point in time? In 2008, 2009, when Bitcoin was invented, that you may have heard of, that was really the first example of solving this problem of how does the network come to consensus over the state of the ledger. And it did that through economic incentives. It did that through, we have miners in the Bitcoin network. Their role is to update and maintain the ledger. In return, as a reward, they get Bitcoin as a cryptocurrency. But Bitcoin isn't the key part here. Bitcoin is just the incentive to maintain the ledger that the network holds. So if we drill blockchain down to its base level, blockchain is a programmable, decentralized ledger of information that a network of computers all across the world maintains, and that network is maintained through the use of economic incentives. So how do you incentivize the network to keep updating the ledger correctly? How do you keep bad actors out of the system? I'm not going to go any further than that to talk about blockchain and its technicalities. We can get into that if you wish. But it's a little bit unclear about why you should really care. Now, there's a lot of small writing on this font because this is basically a history of the world. So if you go back 5,000, 7,000 BCE, humans invented writing to create ledgers. The first clay tablets that we know weren't letters to people, they weren't Bibles or religious texts, they were records of who owns these sheep and who owns this cow, right? We invented writing to maintain ledgers. And we've had a whole range of other ledger technologies throughout history. What those clay tablets enabled us to do was to create the market society. It enabled us to have property rights and to trade. We also invented double-entry bookkeeping that enabled us to have much larger, verifiable organisations over bigger structures, over bigger spaces. When we got digital ledgers, like spreadsheets, it enabled global financial capitalism that we saw in the 20th century. All those ledgers are centralised. They're held and updated by a third party at some point. In 2009, we got a decentralised ledger in terms of a blockchain. And now we're thinking, what does this do to the structure of an economy? If we look back, when ledger technologies change, so does the shape of the economy. We have a new ledger technology. What does that mean? Well, we're developing the foundational theory at RMIT to try and understand this. We're calling it institutional cryptoeconomics. We're not fantastic at naming things. It doesn't roll off the tongue particularly easily. But what we're doing is we're taking existing, largely economic theory, and we're trying to understand what this means for the structure of an economy. In particular, what I want you to understand is that as an institutional economist, I'm an institutional economist, I look out at the world and I go, there are firms, we have hierarchies that are firms, we have governments who maintain ledgers as well, and we have markets who maintain it through decentralised, really, reputation. In 2009, we think we got a new type of governance technology for ledgers. Blockchain is more comparable to the joint stock company that was invented than it is to the steam engine or to electricity or to those production technologies that we know about. It is a governance technology. It maintains ledgers of information. And the question now is, what economic problems we had in society that were previously solved by either creating a firm and having hierarchy and management dealing with the ledger, or solved through a government maintaining an intellectual property register or a property titles register or citizenship or your license, or you can think of thousands of them. Which of those are now better solved through a decentralised blockchain type technology than those other ones were? Blockchain is not just cryptocurrency. There are a whole bunch of applications that people are working on at the moment. Right? I've listed a few up there, and I'm not going to go into them in detail. We can talk about them further if you like, but they're all basically examples of where we currently have ledgers that are centrally maintained that could potentially be decentralised. They won't all be. For some things, firms and hierarchies will still be better at dealing with the problems of maintaining and updating the ledger, and governments will still maintain some as well. But we're going through a discovery process now of which ones are better. So, to supply chains. What does blockchain mean for supply chains? It's not exactly clear what the ledgers are that I'm talking about here in a supply chain. Well, I know I've got a lot of trade lawyers and economists and so on in the room, so we know that we use supply chains to get goods from A to B. I'm going to focus on physical goods here. The same principle really applies more broadly. So when we talk about trade costs are the costs of getting that good from A to B. And they include transportation costs and political costs and regulatory costs and so on. And we want to lower trade costs, because the higher trade costs are, the fewer trades we can do, the less globalisation we have. That's bad. Throughout the 20th century, we reduced a lot of trade costs. Okay, we had technologies like the standardised shipping container in the 1950s and 60s, air transport and so on, that lowered transportation costs of trade. It became cheaper to physically move the thing. We also effectively invented this new technology of these global coordinating bodies, like the GATT and the WTO. This was an invention we came up with to lower trade costs. It negotiated reductions in tariffs and quotas and all of these direct political trade barriers that you see when you hit a border. But blockchain will fundamentally act on lowering the information costs of trade. So what do I mean by that? when physical goods move along supply chains, information about those goods must also move with them. It's not just the physical good that moves. We have to move a whole host of information about the goods. This information, so the information costs of dealing with that are that it's not free to produce this information along a supply chain. Someone has to be maintaining and updating that ledger of where did this lobster come from, or where did this tuna come from, or my diamond, or whatever it is. So what I mean by information costs are the costs of coordinating trusted information between the distributed parties all the way along the supply chain. So producers, consumers, shippers, governments, all the actors, in a potentially hostile environment. There may be some people along that chain who, well, A, they might not want to produce the information, but B, they might want to commit fraud, or there might be some sort of other error. How do you coordinate this information? This becomes much harder for complex goods like aeroplanes. So something like a Boeing 737 has about 2.3 million parts that goes into it. That's a lot of information to deal with and a lot of costs to get that into the one spot. And for longer supply chains. As we globalise, those information costs become higher, and we know that. So let's dig a little bit deeper. Consumers want to know a lot of information about the things that they buy. They want to know where their goods are from. They want to know how they were transported. They want to know any other information about its quality. So these are things like organic and fair trade and all of those sort of things that you see as well. And these things aren't necessarily visible when you pick up the thing in the shop. You can't look at it and go, oh, that's a fair trade coffee bean. Right? Someone has to produce the information and you have to trust it. And most importantly, that is the information that determines how much you will pay for that good. I will pay more for an organic vegetable than I will for a non-organic one, but I have to trust that it is that. Governments want to know a lot of information as well. Governments want to know information about biosecurity risks. They want to know about ethical standards. They want to know about are there relevant import duties and so on. So governments also want someone to produce all of this supply chain information. This is increasingly the case as regulatory states grow. As we have more and more domestic compliance requirements, those information costs go up. I'll skip over this briefly, but there are lots of other information costs along the supply chain. Producers want to know, is there fraudulent activity that's occurring along my supply chain that's affecting my brand? If I'm an artist in a more digital supply chain, I want to know who consumes my final product. Where was it remixed? Where did it go to? These are all the information costs. So very simply, here's a picture of a supply chain. We start off at the very bottom, where the actual product was produced. And then as a good moves along, it gains identity attributes. So it might sit on the tarmac in Dubai for 2 hours and get really hot, right? But they cool it back down before it ends up in London, so it's all fine. This is all information that isn't necessarily visible at the end, and we're adding information along the way. So how do we produce all this supply chain information? So I've said there's all this demand for information. Who produces it? Well, at the moment, we're not particularly good at doing this, right? What we do is we basically take all of the firms along the supply chain, so all these little hierarchical firms, or big ones, and they pass pieces of paper, often paper pieces of paper. And yes, there are efforts to take the paper and put it on the internet, but it's still the same organisational principle. We're still having hierarchies that have siloed information that are writing down this many sheep or beef or whatever it is. It's still the same organisational thing, even if you digitise it. The cost might come down a little bit, still the same information. This leads to error and fraud and all these problems. So what about blockchain? Well, our argument is, and there's a lot of companies working on this, is that blockchain is a new economic infrastructure for the supply chains that we have. So what blockchain does is, rather than passing pieces of paper or digital documentation between different hierarchies along a supply chain, we will use blockchain technology as a ledger of a good as it moves along. So imagine a digitised version of a particular good. We could call it tokenised. And as it moves between parties along the supply chain, Information gets added, never gets taken away. Information is always added in a blockchain. You can't go backwards. It's always there. So this is information about, time-stamped information about quality, location, who owns it, who's got finance on it, all of these questions. We can use blockchain as the way to govern that information rather than using passing between hierarchies. That's what I want you to take away from this. Note that the trust here is provided by a decentralised network. It's not provided by a third party coming in and saying, we will maintain your supply chain for you. It's actually maintained by the network itself. Now, how does this work in practice? We don't know. Right? There are heaps of different ways that this is being built at the moment. Massive companies are working on this, like IBM. What could happen is that each of the participants along a supply chain could scan QR codes that upload information to a blockchain, that when you are a consumer at the end and you're sitting in your restaurant in Shanghai, you can look back and see exactly where this lobster came from. Right? That's one way we can do it. The problem there is, how do you know that good information is going in? It doesn't really solve the problem of fraud. I could just swap this lobster for a different dead lobster and just send it back along the chain. Well, this is why a lot of people are working on Internet of Things applications. So building things like smart containers. So a container covered in sensors that's telling you, was the container opened? How hot was it? Where is it? All of these sort of questions. Uploading that information automatically to a blockchain that cannot be changed. No one can change it once it's there. So that even if you might still have a last mile problem at each end, you're pretty confident that the shipment of wine that came from the Barossa in South Australia was in a sealed shipping container until it got right to the other end. All right? And we can talk about some of the issues around that in a second. There's a lot of work here on Internet of Things, together with blockchain. And there's a lot of talk about smart contracts. Smart contracts. Take your existing paper contracts, code them, and they automatically execute. I'm talking to a room with a lot of lawyers in it. Obviously, there are a lot of problems here with incompleteness of contracts, dispute resolution, all those things. People are working on this. But just imagine for a second, insurance and international trade is a massive problem about how do you make an insurance claim. Imagine if this container, smart container, goes above 3 degrees Celsius, a smart contract triggers a payment back to the original person who shipped it. You can worry about disputes afterwards, but you can code insurance contracts in that way. Now, I'm slightly running out of time, so I'm going to run through a few things. So what does this mean? This isn't just cost reductions in trade. So don't just think about the existing supply chains we have and say, oh, they're going to be a bit cheaper. That's not very interesting, it's not very exciting. We're trying to work out, what does this mean more fundamentally? Well, if you have better information about goods, then we can better differentiate goods that you buy. So we all have this idea of what commoditization is. Commoditization is when you sell a product as if they are exactly the same and for the same price. We think there's a lot of goods in our economy at the moment that are effectively commoditized or sold for the same price, that if we had better information to differentiate them, we would sell them at different prices. I would pay a different price for a 1-day-old lobster compared to a 2-day-old lobster. The problem is, at the moment, the trade costs are too high to actually determine that. So I think we're going to go through a process of decommoditization, which means much more niche markets of differentiated goods with different prices. And this will be a discovery process. We don't know which ones will actually be decommoditized and which ones won't be. But we kind of understand the principle, right? Recently, we've been through decommoditization with coffee. We've been through this process now. You can buy single origin, you can buy fair trade, you can buy all these different kinds of coffee. That was decommoditization. We previously sold coffee as much more a standard lump. All right, so changes in prices. We also think there's shifts in economic power. Excuse me. I've spent too much time on a plane in the last week. My body's confused. So supply chains are riddled with information asymmetries, which is when someone holds more information than someone else and they use it to their advantage. We know this. Well, if blockchain can lower those information asymmetries, you'd actually suggest a fundamental change in who has the bargaining power along a supply chain. So let me give you an example. You're at a restaurant in Shanghai. You want a lobster. We really like the lobster example. We just keep going with that. You're in Shanghai. You want to buy a lobster. You go to a high-end restaurant to buy that lobster, and you trust that the high-end restaurant has verified their supplier and that that is a legitimate one. The restaurant is capturing the value there of dealing with that information asymmetry. You are paying a premium that they are solving that problem of your uncertainty. As we solve that problem and a consumer can better verify, you would expect the consumer to have more bargaining power. There's less value captured there. On the other end of the supply chain, a coffee grower in Papua New Guinea, if they have better information about how much their coffee is finally sold for, rather than just sending it to a distributor near their village, they gain greater power in the supply chain as well, and they can switch distributors. There's a lot of work going on in developing economies about this too. And we can talk about that further too. I'm definitely running out of time now. One last prediction. We developed large firms called U-form organisations with sales and production and research within a hierarchy. That was the way that we produced. Then we went on to develop what are called in economics M-form organisations. And what we did was to create bigger and bigger firms, we split them up into distinct units, which enabled multi-divisional international companies. They had profit and loss within each of the units. This was a way to make bigger and bigger companies. And this is why we see so many multinational companies today. We think blockchain's going to do the opposite. So to the extent that there are big firms in supply chains dealing with trust problems, so dealing with the problem that I don't know if you're going to produce the correct widget that goes into my airplane, so I'm just going to buy you and I'm going to produce it myself, which is what a lot of supply chains are. We're going to see an opposite process where we will outsource that. What we would have previously done as a big firm, we will outsource it to a decentralised ledger. What this means is that we end up with smaller firms. We end up with more niche firms because they haven't had to vertically integrate to overcome those trust and information problems. I've got about a minute left. We can talk about policy afterwards. How do we get from here to there? It's going to be a rocky road. There's going to be a lot of arguments about policy. We're doing a lot of work in this space. For instance, will governments recognise blockchain-based supply chain information when I turn up at the border, or will they say, can you just give me that paper form, please? Can we move towards more technologically neutral providing of information? Not just digitising the form in its current way, but thinking about the form in terms of the fields that are in that form. How will we deal with how different regulatory systems interact? The Chinese government and the Australian government have different domestic compliance requirements. How do we deal with that problem? And this isn't my particular area, but there's going to be massive competition law issues here. So at the moment, you've got IBM going out there and they're trying to build, IBM has become a blockchain company. If anyone hasn't realised, they've said this is the next big thing and they're dumping all their money into blockchain. They're trying to build this infrastructure. They're thinking there's going to be one big player that owns this blockchain-based infrastructure, and we want everyone to jump on board. So they've teamed up with Maersk and they've created this thing. Massive competition law issues here. How do you go out and regulate these multinational protocols? So how does competition deal with the issue of protocols controlling huge amounts of trade? That's going to be a big one. I'm going to leave it there, and we can talk about more about this in questions. There's a bunch of things we've written this year. Oh, if anyone wants to take photos, then feel free. This is all on the internet, and feel free to email me. If you want to work on blockchain stuff, email me, call me. We collaborate with everyone. Everything's co-authored, so please feel free to reach out. Thank you.